Welcome to the Life Unlimited podcast with Larry Heller. You deserve complete financial advice so you can confidently live your life your way, for life. Now, let's get into this week's podcast episode.
Hello and welcome to another Life Unlimited podcast with your host, Larry Heller. Today, we are going to talk about the 6 retirement killers. And Larry, let's start off right out of the gate here with giving credit where credit's due.
Yeah, so this is an article I saw in Kiplinger magazine. So I thought this is great because they hit it right on the head with a lot. But I thought I would expand a little bit more and put a little bit some stories into this mix as well. But if you're about to retire or in retirement, be aware of these 6 potential killers.
I love the first one because this is where a lot of people don't put enough value in this one. So let's start with the plan.
This one is huge because if you don't have a plan when you retire, you have no idea how much you can spend, how much you're spending, how much you should do. So a lot of people come to us, they're about to retire and they have no guidelines, no what is that, gutters on the bowling alley side. So they've been getting an income. A lot of people have been working and they get the salary every week, every 2 weeks, and all of a sudden that's going to stop. And now they got to take out money out of their retirement accounts. I mean, yes, they may have some Social Security that comes in on a reoccurring basis. But if you just haphazardly pull from this, and if you didn't create a plan to see how much money that you can spend, a lot of times you don't know if you're going to have a successful retirement. And it works both ways, whether you're going to have enough money and not run out of money, one, but also maybe you don't spend enough money in retirement. So the first thing is really worrying about not having enough money, but it's also spending enough money. When we put clients onto a written plan and they can see it and they can see, okay, this is going to work. Now they can relax a little bit more and they can feel confident that what they're doing and what they're spending, and they're not worrying about it. Because I don't care how much money you have the first year that you retire, and you're definitely nervous about kind of, what am I doing? How do I do it? Go through it. So having a written plan, and it's been proven, it'll make you more successful. Whether you're retiring or not, having a financial plan will make you more successful.
Just such a nice, again, the gutters on a bowling alley, guardrails, going down a highway. It's just nice to know what your parameters are so that you, as the financial services professional, can also make adjustments accordingly in case there's too much or too little, which really leads us into the next one, which is, man, Larry, people just don't really understand how the markets work.
Well, yeah, I mean, there's a couple, overly optimistic investment assumptions is really, you may be looking at your returns from the last year and saying, oh, wow, this is a great year. I'm going to get 15% every year on my money. So I'll just keep the money in equities. And then boom, then they go through a year where it's down. Then they sell at the worst time to put it all in cash. And then they miss the upswing on that. So really, rather kind of be conservative. When we create our retirement plan, a cash flow analysis, we use very conservative numbers in there, because better having a surprise on the positive side than having a surprise on the negative side. So you don't want to just look at totally historical numbers. So a lot of people, well, my bonds earn 7%. Well, Matt, what was interest rates a few years ago?
It sure wasn't 7%, brother.
It was close to 0. So you can't just assume that you're going to be getting these year in, year out. You've got to kind of go through that and use a realistic ongoing amount. Also, what we do, which they didn't mention in here, which is also could be one of those killers, maybe a 7th killer, is the I word. Okay. What's the I word? You're on the spot. I'll help you out. Inflation.
Oh God. Yes. Oh yeah. Holy Moses.
So not accounting for inflation when you're doing both your written plan, but putting in your numbers here as far as being overly optimistic or pessimistic, putting in a realistic inflation number. So making sure that you have the right numbers in there. And of course, what we want to do is we want to kind of put a certain amount of money sitting in cash or CDs or treasuries. And we've talked about our reservoir strategy numerous times. But if you have enough money to go maybe 18, 24, 36 months, somewhere around there, depending upon what's going on, that money should be sitting in a cash account. Now we're getting a little bit higher rates of return as we're speaking today in August 2024. We're getting 5%, but that may go down. So you got to take that kind of out of the assumptions too. So when you're putting together an asset allocation based upon a diversified portfolio, if you're missed by 1 or 2% over a 20 or 30 year difference, that's huge. That could mean the difference being whether you have a retirement plan that works or it's not. So make sure that you have realistic investment projections in your plan.
You know, I know that we've talked about the moat in the reserve a number of times, but I want to reposition that back to the overly optimistic investment assumptions, because again, the markets go up and down. And what a lot of retirees do is they're plastered to the markets to see what's going on today when they know that they don't have to sell for 18 to 24 months. We know that that lowers their stress level and allows them to focus on what they should be focusing on, which is really living the retirement that they've dreamed. Now, you hinted toward this next one, which I think is number 3, a little earlier, which is that a lot of people are concerned that they're spending too much, but you and I've had many conversations about this. Sometimes they're just being far and away too frugal.
I would say that most people come in here and they're planning on spending less than they actually can. They're so nervous about it and they haven't run in numbers that they spend less. And when we go through the plan and we show them the analysis and we show them the reservoir strategy, it gets them really comfortable. So now they can spend more. So when they're hearing me saying, go ahead and spend more. Sometimes we're telling people they're in a higher estate tax level. I said, if you don't spend it, the government's going to come in and take another tax out of it. But yes, spending more. So talking about that. And a lot of it is kind of on the upbringing. We had a client in a few weeks ago, extremely successful, one of our biggest clients. And we were talking about her childhood and where she came from and struggled and poor. And so even though now that she's got significant wealth, getting to do that, to get out of that background and what she's used to, and we're talking about years and years later, is a mindset. But so you want to balance both. On the other hand, there are some people that come in and say, well, I want to do this and I want to buy this house and this house. And I'm like, you know what? Well, look at the numbers and we're showing that's not going to work. You now need to kind of look at paring it back. So, not being too frugal, not being, you don't want to spend too much, and then looking at this on an ongoing basis because life changes. What you want to do, what you want to spend changes. Of course, health comes into play here. Health expenses come into play. So we have a couple of podcasts that we've done, Matt. There's one we did on spending enough. It's called "Are You Spending Enough?" episode 136. So go back and do that. And when we're talking about the reservoir strategy, you can also look at our reservoir strategy, which was episode 119. So 2 other episodes talking about retirement and kind of how to go about doing it.
Those sorts of, baggage that happens with a lot of people, especially when it comes to retirement money, how they're feeling about money, are things that financial advisors really have to be specifically trained to help manage. And I love that you have spent lots of time in your personal growth and education learning how to manage some of the behavioral components of what it means to manage money. Because if not, what happens is if you don't have an advisor who has the level of training and experience that you do, sometimes they will just blindly trust them, which can be and it's actually, the next retirement killer.
Yeah. So I remember, early on, I was working with a divorce client, and her ex-husband did a had his financial advisor do a retirement plan projection. And I don't remember the exact numbers that they would percentages. I think maybe he was using a 10% rate, could have been greater than that. So in 25 years, they was showing that she was going to have like millions and millions of tens of millions of dollars. And he was telling her, you're going to be fine, Fennec. Don't worry about it. Look at this report. And I looked at it. I'm like, yeah, because those numbers are not realistic to get year in, year out. I said, if we change it, we bring it back down a few percentage points and now we run it, look at the difference. So you really the going about, we talked about the overly optimistic investment options before, but really making sure that you're not solely kind of relying on somebody out there who's not an expert. A lot of these programs are done by big brokerage firms, and they're spit out, and they're not overseen by a qualified, certified financial planner with experience and looking at this and looking at the financial planning side to really make sure the plan that you're putting in place is reasonable.
You know, there there are, a lot of people out there that say that they're planners, right? But they're either wicked product specific focused, or they're these one-page financial plans, which is not a real financial plan. And working with somebody who's a certified financial planner, who's gone through that time continuously doing all of the education, can make a big difference. And you dove into this more deeply in episode 154. Do you remember what that puppy was about?
Yeah, that was kind of a deep dive into our services. And just expanding on what you just said there, a lot of times, there's a big brokerage firm and there's your investment advisor, and they're not even doing the financial plan. They're taking the numbers and they're giving it to somebody with a year or two experience behind running some numbers and then gives it back to them. They're not really getting to know to understand the client. I mean, the first thing when somebody comes in, we talk about what's important to you and really learning about you, learning about what you want to do, because knowing those things helps to devise a plan and helps to devise a plan that's going to work. And there are so many factors. And then if you don't ask for so many factors in there, I mean, one of the things that sometimes we ask for is, do you have long-term care insurance? And then you say, well, why do you need to know if I have long-term care insurance if my retirement plan is going to work? Well, if you have a good long-term care insurance, and a lot of times you can't get your hands on that anymore, that maybe you don't have to allocate as much for a potential illness. But if you don't, and you're husband and wife and you're in your 60s, there's a good chance one of you may need some additional expenses along those lines. So you may want to account for that a little bit, or finding out a little bit about their health condition. Do they have any type of illness that may cause them to have longer term, talking about their parents and their parents' history. So there's so many kind of abstract variables that you need to kind of discuss and know when you're talking to your advisor. I tell people, besides their doctor, I'm going to know more about them, I should, than any other advisor out there, in order for us to put a great financial plan and a great retirement plan together for him.
Well, in that episode, talking about financial planning, one of the things that I remember you talking about was the idea of that the plan does need to be reviewed on a regular basis, and it is going to change over time. And you did, what a nice example. So you retire, and then your retirements need change because let's say somebody does get sick, or maybe they don't, and they're wicked healthy at 80, right? Your financial plan should be adjusting and reviewed on a regular basis to make sure that those adjustments are made. And the big brokerages or wirehouses or whatever you want to call them, they're going to deliver you something to close the business. You are a number to them. It's not a real relationship.
Yes. I mean, there's so many things that was popped into my mind. When a client came in, we're doing some planning, and they were talking about spending a lot of money on travel, but they were only doing it for 10 years. And I said, well, what happens after 10 years? Well, we'll be in our mid 70s. It won't be. I said, I got clients in their 80s that are still getting on planes and going to Austria. How do you know that you're not going to be able to you don't know that you're not going to be able to do that. So, planning for those, or people say to me, well, I'm going to stay in my house forever. Yeah. And I'm like, where's your main bedroom? Oh, it's on the second floor. Do you have any bedrooms on the, no, no place in them. Well, maybe you'll be able to stay there. Hopefully you do. Maybe there's options of putting in some type of elevator or something up the stairs, but maybe you won't. So what is that going to look like if that has to change some? So all these kind of conversations will change over their lifetime. Where are we doing this and looking at this analysis every year to see what happens and see what's going on?
Yeah. So I love that you talked about the chairlift going up.
That's what I meant. The chairlift going up. Yeah.
I remember that commercial as a kid, watching the person sit down and going up. But the interesting thing, and one of the other considerations that is a huge retirement killer, is your generosity, right? And even in the house situation, a lot of people are starting to move in with their children. But let's talk about the kids, because this can be a huge retirement killer. But I would like for you to keep in mind and maybe elaborate on the fact that some of the people now who are getting up in age, 70, 80 years old, are actually opting to move in with their kids' families to be closer because long-term care facilities are so expensive.
Right. So you kind of got this, sandwich generation that I'll call it. So you got both sides. You've got your younger kids who, listen, buying a house today, I don't care where you are in the country, is a lot more expensive than it was years ago. And, I've talked to a lot of people, and one of the things they're looking to do is help their kids either with childcare, either doing it themselves or paying for it, or helping them with a down payment of the house, or helping with rent. And that's all great if you can well and afford it, but can you? So, and a lot of times, a lot of people, they think they can because they're not doing all the other items. They're not creating a plan. So they have a big chunk of money now, but they're not realizing that chunk of money has got to last them a long time. And there's got to be a bigger chunk enough in there in case they need some other type of expenses. So be careful not to overextend yourself for your kids. And I know sometimes it's really hard to say no, especially if they have a cute grandchild or two that you want to do that. So again, not to say that you shouldn't do this, but don't overextend yourselves. It's like the story that Kipling just talks about is when you're in the airplane, make sure you put your mask on first before you help your child's masks on. So if you can do both, great, but just make sure that you know exactly what you can afford to do.
Larry, as a person who loves analogies like that, I have to say that putting your mask on first, the only time I ever really hear that ever talked about is when I fly.
Yeah.
What an important thing for you to understand, that if you're not taking care of yourself first, then your ability to help your children and your family later down the road is actually going to be diminished over time. Now, which can be really, really, really risky, right? Helping out, a grandchild start a business, helping them pay for blankety blank as the list that you just said. But risk is the sixth retirement killer. So let's dive in.
Yeah. So again, how risky are your investments in your retirement, and do they know what risk is? So, and sometimes they've done very well on this risk, but they don't really know what their risk is. And literally, we've just had a client, a potential client, come in the door, and 6 stocks made up 45% of their portfolio. So, but those 6 stocks were great stocks for the last 10 years. So they've seen their portfolio dramatically increase. They're saying, well, why do I have to worry? These aren't going to go down. But really trying to explain the risk that they have and point out that there are plenty of times in history where we've seen some tremendous corrections, and what will happen to your portfolio, what would happen to your retirement if we go through one of those times. So making sure that you have the correct asset allocation, making sure that you have a diversified portfolio. Now, look at this person who came in recognizing the risk and is willing now to say, it's time I should kind of take some of this off the table, diversify, and make sure that it's done properly. And then even knowing the risks. I mean, we try to educate people that come in the door, at least on a high level, to understand that we talk about money being in stocks and the investment. It's not going to go to zero if you're in a diversified broad index fund. It's going to go up and down, but it's not going to go to zero. You know, if you're in a stock and that stock happens to go bad, you could lose all your money in that one. So there's a lot of different risk in an individual stock than there is in a diversified equity portfolio. And there's different risks, but within equities, large cap, small cap, and there's different risks between cash, bonds, and equity. So knowing your risk. So we start with every client fills out a risk tolerance questionnaire, because what we want to do is we want to know, okay, what is that kind of pain point? So when we have a correction, you're not going to sell, because we know when we do have a correction, things are going to go back up, and we don't want things to, we don't want you to sell there. So we start talking and educating right from there. And we talk about the 18 to 24 months, sometimes even 36 months that we want in cash reserves. So when we go through these corrections, that you'll be fine. You won't panic when you turn on the news. You'll remember us. And so knowing your risk there helps your retirement. We're doing this in August. A couple of weeks ago, we had a 1,000-point drop in the market. We had no clients calling us. Mm-hmm. We sent out an email that day. We got one response on the email. Sometimes, usually when we go happen, we send this out. Some of the clients are like, oh, is it time to rebalance and buy now? And that's kind of the mindset you want to kind of think about. So you want to have a balanced portfolio. You don't want to have too much risks. And speaking of risks, you can tune into episode 129 when we talk about a little bit more of those pitfalls. So you want to construct a portfolio or reservoir strategy that makes sure you have your cash needs, your intermediate needs, and even your equities long time. People come in, they're 65 years old and they're retiring, and we're talking about long term, and they kind of look at me and I say, long term, what's 10 years? 75 is not that old anymore. So, so you still want to make sure that you construct your portfolio for a short period of time, because you don't want to under risk that. You don't want to take all your money and put it in just the bank, and then inflation eats it away and you don't have enough at the end of the time. So you want to make sure that you don't take on too much risk, but you want to have a diversified, balanced portfolio that's going to outperform inflation and get you to the income that you need so you can enjoy your retirement and don't fall as one of these killers.
Yeah. Well, Larry, I'm sure that there's going to be people who want to know more about how you can provide them with the guidance so they don't fall prey to these retirement killers. Where should they go?
Sure. Best to reach out to us on our website, hellowealthmanagement.com, and you can click right on there and schedule a 20-minute call with me or one of the other advisors, and we can talk to you about creating a non-retirement killing plan for you. Or you can reach us at 631-248-3600.
Listen, and the other nice thing is Larry did a great job of referencing previous episodes. If you have not subscribed to the show, or if you haven't listened to those episodes, we'll make sure that those are in the show notes, but please go back and listen to the whole library that Larry has created over the last number of years to help you make better financial decisions so that you really can have your life unlimited. So
and one more thing, you also now you can also go to our YouTube channel where you can watch all these videos. So it's Life Unlimited, Larry Heller, Life Unlimited, and watch all these podcasts as well.
Fantastic. Well, go to the YouTube channel. We'll make sure we have a link in the show notes too. But thank you very much, Larry, for all of your wisdom and passing it on. And we'll see everybody on the other side of the mic very soon.